what kind of role does gold play in an investment portfolio?
Yeah, well, I think gold's role, and the first thing I'd say is gold. We've gotten 5,000 years of history in terms of the role of gold, or to see and understand how gold functions as a financial asset. And I think that's an important thing because gold is different from extractive commodities, which have like productive value, or stocks or bonds that have a clear have a clear reason why they would have yield over time, right? So somewhat of a fundamental valuation that can be thought of relative to the cash flows that they'll produce. Gold's different, of course, because it has de minimis industrial value, and also offers no yield. So you put that together, and that's a very interesting asset. And so you do have to understand it in the context, like how gold works and how gold functions and performs as a financial asset, is a matter of psychology. Like, that's very interesting. Like, a very interesting thing to think about,
Yeah.
that it is a matter of psychology. Like, it's not a matter of fundamentals, it's a matter of psychology. So you have to understand the psychology, and the psychology basically holds in a couple different ways. First of all, gold serves as a contra-currency. And what I mean by that is that paper currency has a certain value
Yeah.
that's expected over time, and gold is a contra to that, in the sense of it is an alternative currency that you can hold your assets in, that is widely accepted, in the sense of everyone in the world, people buy gold in all sorts of different ways, and has been accepted throughout history. And so whenever you're thinking about gold, it's important to think about it like, I can either choose yielding paper currency, right? Or I can choose non-yielding gold. And what you see is, in times when people start to raise questions about the value of paper currency, you often see gold outperform paper currency. And the other thing is, at times when you see interest rates rise on paper currency, you typically see gold underperform.
Yep. Yeah.
Right? Because one has yield and one doesn't. And that's just a natural trade-off. And so I think you want to think about it with those fundamental dynamics. And in that context, it allows you to start to think about, okay, what are the circumstances, the outlier circumstances, the unusual circumstances where you'd expect to see gold do well. And that's, places where you have to have meaningful currency devaluations. Like, interesting, in China today, just as a simple example, in an environment where there's meaningful capital controls, right? What are they doing? They're going to buy gold, and gold's trading at like an 8% premium in Shanghai over what its price is in London. That's in that, it may be a pet rock, but it's a pet rock that all of humanity across cultures has largely identified as being the pet rock you want when you want to be able to store, have a storehold of wealth.
Yeah.
And so that's a good example. There's also a situation where, let's say you think that there's a risk of a meaningful easing of monetary policy, an unreasonable easing of monetary policy, let's say, because, let's say central banks haven't beaten back the inflation dynamic, even though they're starting to shift their interest rate policy. That could be a good time for gold, because it's a circumstance where the value of paper money versus stuff is starting to get depreciated. And you see a circumstance where yields are starting to compress. Those two things set themselves up for actually quite a good circumstance for gold. And so you want to think about it from those fundamental perspectives. And I think what you'll find, if you look through time, is that gold is a pretty good diversifying asset in a lot of circumstances. As a simple example, if you go back and look through time, in terms of like rolling 12-month periods where U.S. equities have been down over the last 75 years, gold has outperformed bonds in more than 50% of those circumstances.
Yeah.
Okay, well, and then you just compare that and you just say, that's empirical evidence, and I could go show that to you across developed countries. I could show you across emerging countries. It's a little better for emerging countries because of the contra currency stuff. But you put that all together, and then you say, okay, so how much gold do you have in your portfolio? And someone's like, no, none, because you'd be a crazy person to hold gold, because only
Yeah.
weirdos hold gold. And I'm sitting there going, like, what? I'm no, living in a bunker gold bug. I'm just looking at the empirical evidence, and I'm like, well, this seems as good as a diversifier as bonds are. So, like, maybe I should just kind of hold them in an equal weight. But yet that's like a radical difference. Like, everyone in the world is overweight bonds, and basically no one holds gold. even though the empirical evidence would suggest that there's like very good reason why you'd want to hold gold over long time frames.